Hi, this is Ratan Gupta from Knowledge Varsity. We will be covering reading 61 of the fixed income. In this reading 61, we will be going through what are the risks that are there in investment in bond. Okay. This recording is brought to you by Knowledge Varsity. We conduct both live and online classes. Okay. So let's see what are the various type of risk that a bond investor is exposed to. Okay. So the risk that are present in the bond can be divided into two parts. Okay, one is the interest rate risk. Most of the risk are coming from investment in bonds which are due to the interest rate, and then the other risk. Okay, so in interest rate risk, what are the risks? One is the yield curve risk. That is, what will happen if the shape of the yield curve changes. Okay. Second is the call risk. That is the risk that the bond will be called back by the bond issuer. Prepayment risk. That is the bond issuers will prepay the money. Okay. Reinvestment risk. That is the bond is paying regular cash flows like coupon. If the interest rate falls, the bond holder is forced to invest the coupon at a lower rate. So that is reinvestment risk. Other risk, credit risk. Since the bonds are, most of the bonds are issued by the corporations, there is a probability of default of those corporations. So there is a credit risk involved. Okay. Next is liquidity risk. Okay. Many of the bond issues are not actively traded in the market. There is bid-ask spread differences there. So as a result, you usually poll a group of traders to find out the price of the bond. Okay, so this is the liquidity risk. That is, you will not be able to sell those bonds very fastly, so that cannot be converted into cash swiftly. That is the liquidity risk. Inflation risk. Bonds are fixed income instruments. They pay fixed coupon payments, but during times of inflation, the coupon that is being paid or the interest that you will earn will not yield anything in real life. Okay, so whatever is being paid is nominal, not real. Okay, volatility risk. This risk is present for the bonds having embedded options like callable and puttable bond. Okay, so due to the volatility of the interest rate, these callable and puttable bond prices vary. So that is one more risk to the bond investor. Okay, then there are other risks like event risk. Okay? So some of the risks which are not in the hand of the bond issuer or holder, that is like, let's say there is a plant of a manufacturer and it catches fire. Okay, so that is an event risk. Okay, sovereign risk, that is the risk that comes due to the regulation of that country or from the country that is in which the corporation is based out of. Okay, then there is exchange rate risk. If you have invested in bonds of corporations outside your country, you are exposed to foreign exchange risk. Okay, so these are the risks that a bond investor is exposed to. Okay, let's go now to what exactly would be the price of the bond with respect to the interest rate in the market. Okay, so the price of a bond, the bond would be trading at par value. The bond will be trading at par value when the market interest rate is equal to the coupon rate. Okay, so when the coupon rate and the market interest rate are the same, the bond will be trading at par. Okay, when the market rate is less than the coupon rate. Okay, so let's take an example that the market rate is 10% and the coupon rate is 11%. Okay, so in this case what is happening is, if you make any investment, you will get 10% return, but this bond is giving you 11% on the face value. Okay, so everybody will go and buy this bond. Okay, So the price of this bond will increase than its face value or par value, such that effectively it will yield the 10% market rate. Okay, because there should not be any arbitrage. Okay, people may get 11% bond by borrowing at 10%. Okay, that will not be happening. So bond will start trading at premium than its face value. So effectively what will happen is the bond will yield that market rate of 9%, or sorry, or 10% of market rate when the coupon is 11%, and the bond will trade at a premium. On the other hand, if the market rate is 10% but the bond's coupon is 9%, okay, so nobody will want to buy a bond when they are able to invest in the market at 10%. Okay, so what will happen is the price of the bond will fall. Okay, it so happens because the coupon rate is fixed. If the coupon rate was variable, this would not have been the case. Since coupon rate cannot be changed in a bond, the price is a variable, the price changes. Okay, so let's see by taking example. If the market rate is, let's say, 10%, okay, and the coupon is 10%, bond will be at par. If the coupon is 11%, the bond will be trading at premium. If the coupon is 9%, the bond will be trading at discount, because coupon cannot be changed. So as a result, price will change. So here the price will be $100. Okay, here the, let's say, the price is, let's say, $110. Here let's say the price is $90. Okay, so let's say if this is a 1-year bond only, okay, 1-year bond, okay, so if you see, it gives you a it gives you a coupon of 11% on face value, that is 11. Okay, so it gives you 11 and the price is 110. So effectively you are getting 10%, which is the market rate. Same can be seen over here. Okay, this I have taken for 1 year. For bonds having maturity more than 1 year, these prices will be varying. So if you see over here, the price, the return that you are getting over here is 10% only. Okay, so this will be happening in all the cases. So this is a very, very important consideration that you have to know in bond. Okay, in fact, you can do this using your calculator. You can take any random values, and this market rate would be your I by Y in the calculator. Okay, so I by Y is this, N will be the number of payments, PMT will be the coupon, FB will be the future value or the face value of the bond, and you have to find out the PV from the calculator. Okay, just try doing this in the calculator and you can see that what I am talking about. Okay, now we are covering risks. Okay, and we have seen that interest rate risk is the most important risk measure. Okay, now in practice, interest rate risk is measured using duration. So duration is a measurement of interest rate risk. Okay, now the higher the duration, the higher the interest rate risk is. Okay, so interest rate risk, as we have seen, risk can be both sides, right? When the now, okay, going back to this, we have seen that the market rate was more over here than the coupon rate. So market rate was less than the coupon rate and the bond was trading at a premium. Okay, so I will just draw the bond price diagram. Okay, so this is the bond price on the y-axis. On the x-axis you have the yield. Okay, so there is an inverse relationship. Okay, so this yield is what is the market rate. So yield is your market rate. Okay, so there is an inverse relationship between yield and market, in yield and price. When the yield falls, the price increases. This is why we have said that when the market rate is less, then the bond is trading at premium. Similarly, when the yield increases, the bond price decreases, and this is the shape of the curve. This is called as convex. So, or the price is called as that it's convexity. So this is convex curve, like the price, the shape could have been like this also, you can say that, but this is the how the shape is, because the price increases at an increasing rate. Okay, here the price would have been increasing at a decreasing rate, so this is not the case, and this is the shape of the price yield curve in a case of bond. Okay, so higher the duration, higher is the interest rate risk. Okay, now this duration, the duration will be some number. Okay, by the way, duration is measured in years, which we will see later. Okay, but from our perspective, we should know that duration is a measure of interest rate risk. Higher the duration, higher is the interest rate risk. Okay, it is dependent on coupon, time to maturity, and whether the embedded options are present or not. Okay, so let's see what are the various attributes. Okay, so coupon. Okay, now if the coupon increases, okay, if you have more coupon, okay, the duration decreases. Okay, this can be seen like this. So suppose you have invested $100 in a bond. Okay, the bond was for 5 years. Okay, and the bond coupon is $10. Okay, face value is $100. Another bond is there. Another bond is there, same $100, 5 year, but the coupon is $15. Okay, now since the market rate is same for both of these bond, okay, let's say the market rate is 12%, so that let's say the market interest rate is 12%, so this bond will be trading at discount, this bond will be trading at premium. Okay, now in this case you are getting more of your money earlier. Okay, because coupon it is giving more. Okay, in this coupon it is giving less, and as a percentage you are getting more money at the end of the 5th year, so most of your money is exposed at the end. Okay, so due to the fluctuation in interest rate, this will get impacted. Okay, the present value of this will get impacted, whereas here if you see, as a proportion, less of the money is at the end. Okay, so here it's only 6 times, 7 times, here it is 10 times. Okay, so the present value of this money, okay, is lesser in comparison to the coupon. So what happens is, increase in the coupon decrease the interest rate risk. Okay, so this is very important. Similarly, if I have this bond, okay, and I have a same bond, but the duration, but the maturity is 10 year. Okay, so what can be said is that this $100 is being exposed for more number of years for the interest rate fluctuation. So when maturity increases, the interest rate risk should also increase, or the duration should increase. Okay. Next is the presence of a callable option or a puttable option. Okay. We saw that a callable option will enable the issuer to buy back the bond at specified price. Okay, so when there is a fluctuation in the interest rate, let's say issuer had said that he can buy the bond at $102. Okay, and the price of the bond has become $110. This is a hypothetical case. I will let you know that why this price cannot happen, but let's say the price can run up to 110. Okay, issuer will buy back the bond. Okay, so what happens is the risk to the issuer has decreased. Okay, or the interest rate risk has decreased. Same can be the case of puttable bond. If there is a bond puttable at $110, if the price becomes $102, the holder can throw back the bond to the issuer and ask for its refund. Okay, so the presence of these options decreases the interest rate risk. Okay, now this we were talking about the case of fixed bond, fixed coupon bonds. Okay, in floating rate bond, okay, in floating rate bond, what is happening is coupon is resetted at periodic interval. Okay, why resetted? because what happens is, let's say the coupon uh, payment is done every 1 year. So here the LIBOR was 5%. So you will say that okay, next year the uh, interest, the coupon that will be paid is 5.5%. Okay. Here if the LIBOR has changed to let's say 7%, you will say that okay, next year coupon you will pay at 7.5%. Okay. So what is happening is, due to the increase in LIBOR, you are resetting at every point or every coupon payment point the new rate, which is the market rate. So for this period the LIBOR is 5% or the market rate is 5%, and you are asking for the bond correspondingly. So there is no interest rate risk at this point. But what happens is, the LIBOR rate can change. Okay, so the LIBOR rate, let's say this is for 1 year. Okay, so the LIBOR rate can be different for 1 day, 30 day, etc. So in between this there is interest rate risk, but not for the entire period of, let's say if the bond was for entire period of 10 years. Okay, so their interest rate risk is only for 1 year or time till reset, and at the reset point there is no interest rate risk. So interest rate sensitivity is 0 to on the reset date, but there is some risk between the reset dates. Okay. Now we just saw that there is a, due to the call option embedded in the bond, there can be lesser interest rate risk. So let's see what are the what is this graph talk about. Okay, so this red one is the value of an option free bond, which we saw. Okay, that it is a convex, as yield decreases the price increases. Okay, now I said that when the call price is, let's say this callable price is 102. Okay, this callable price is 102. Will you buy a bond when the issuer can call back at 102? Will you buy the bond at a price which is more than 102? Definitely not, right? So if somebody comes to you and say that, boss, buy the bond at 110, you will say no. If I buy the bond, issuer can call the bond at 102 and I will suffer a loss of $8. Okay, so what happens is, this is a value of option free bond. For a bond with embedded option, it will follow this path. Okay, that is, the price cannot be more than the call price. So this price of the bond, what it is being shown is, instead of following this positive convexity, this follows a negative convexity. That is, as yield decreases, the price, it increases but at a very decreasing rate, or it flattens out. So it cannot be more than the $102. So this is a price, this price is of a value of a callable bond. Okay, this is a value of an option free bond. So the difference between these two, so let's say the yield is this. Okay, so the callable bond price is this much. So this is the callable bond price, this is the and this total is the price of a option free bond. So can I say that the difference is the value of the call option, or the price of the call option? Okay, so this is the impact due to the call option, that is, it decreases the value of a callable bond. Okay, in case of puttable bond, it is exactly the opposite. In case of puttable bond, what happens is, the price of the bond is capped from below, that is, it will not decrease below the put price. Okay, so it will not, so the value of the puttable bond will be the difference between these two. So that will be the put option value. Okay, so the presence of this call and put option, it decreases the price of a callable bond. Okay, but it increases the price of a puttable bond. Okay, now we will see another interpretation of duration. Okay, duration, we saw that it is a measure of interest rate risk. Okay, I can also say that duration is a measure of price sensitivity of a bond with the change in yield. Okay, which we will see that duration is being mentioned as the percentage change in the price of the bond when the yield changes by 1%. So if the yield has changed by 1% and the bond price, if the yield has changed by 1% and the bond price has changed by 10%, what people will say that duration is equal to 10% by 1%, or the duration will be equal to 10. Okay. Usually when the yield increases, that is it is plus, the price will decrease, because when the yield increasing there is a negative relationship, the price will decrease. So duration is being mentioned as negative of the value. So negative of negative 10 by plus positive 10. So the formula for duration is minus of the percentage change in bond price by yield change in percentage. Please note that both should be in percentage, both should be in the same unit. Okay. Now for a portfolio, the duration is the weighted average of the individual duration of a bond. Okay, so similar to the portfolio return, it is like for a portfolio, if there are 5 bonds, each of them have different duration. Depending on the weight, the current market value divided by the total market value of the portfolio, the duration will be decided. Okay. But it exposes us to one more thing, that is, we are saying that duration is measured as a percentage change when yield changes by some number. Okay, but when a portfolio has bonds of different maturity, okay, when there is a parallel shift in the yield curve. Okay, now what is meant by parallel shift in the yield curve? So let's say this is the initial yield curve. What is yield curve? Yield curve is the plottation of the yield with respect to the time. As we have seen that there, due to the maturity risk premium, the yield required on a bond of 10-year maturity will be more than a bond of 5-year maturity. Okay, typically that is the case. Okay, but we can have other cases also. So what happens is, this is the initial yield curve. This is the initial yield curve, and what can happen is, there can be an increase in the yield across all the maturity. Let's say there is an increase by let's say it was 5%, and there is a 1% increase across all the maturity. So all the maturity yield has increased by 1%. Okay. So since this is a parallel shift in the yield curve, duration is very easily calculated. For a portfolio, you can easily calculate. That is, what is the change in the portfolio value? So what is the percentage change in the portfolio value by percentage change in the yield? But what can happen is, there is a non-parallel shift in the yield curve. There can be a situation when the yield curve shift is not parallel. Okay. So what I meant by non-parallel shift is, if you see for this maturity, the yield curve has shifted by this point. Let's say it's 2%. Okay. But for this maturity, yield curve has shifted by only 0.5%. Okay. So due to this, the price change of bond of this maturity will be more than this maturity, because what I can say is, percentage change in the bond price can be written as percentage change in bond price, percentage of delta P can be written as minus of duration into del Y. Okay. So bonds are exposed to what is called as non-parallel shift in the curve, yield curve, and that is called as the yield curve risk. Okay. So we spoke about yield curve risk. So this is the yield curve risk. That is, non-parallel shift in the yield curve is known as the yield curve risk. Okay. Now we spoke in the reading 60 that prepayment can be done by the bond issuer. Okay. So what are the disadvantages that prepayment has on the bond holder? Okay. As I said that you had invested considering that every year you will get some coupon, after 5 years you will get $100 as the face value, but because of prepayment, there is uncertainty. It is there on the timing of the cash flow. So you got all your money. Okay, so you are not getting $10 at a periodic interval. So there is uncertainty on the timing of the cash flow. Okay. Also, the next one is bonds are usually called, or people usually prepay when the interest rate decreases. Okay, why? When the interest rate decreases, people can issue another bond at a lower interest rate, right? So they can prepay. Usually when you are taking a home loan, what you will do is, you have taken from State Bank, you will go to ICICI Bank, get the issuance at a lower rate and prepay. So what is happening is, the bond investor or the bank is left with money to invest at a lower rate, because the market rate has decreased. So what happens is, since the market rate has decreased, he is not able to get the earlier rate which he was promised. He is getting lesser. So what he is exposed to is exposed to reinvestment risk. We'll see that what is this reinvestment risk in the next slide. Okay. Also, in case of callable bond, when the interest rate decreases, the price appreciation is capped. So you are not getting the price appreciation which you should have got. So let's see this diagram. If the bond did not have any callable option, that is, bond was not a callable bond, it was a straight bond, so the price would have become this much. Okay, when the interest rate has been this. But due to the presence of a call, you are getting only this price. So this benefit you are losing because of callable option. Okay. So for an investor, he is not getting this price appreciation. So this price appreciation is lost. Okay. So these are the disadvantages of prepayment. Okay. Now let's see what is reinvestment risk. Okay. So reinvestment risk is the risk of investing the money that is received as coupon. Either you receive the money as coupon or the prepayment at a lower rate than what you thought when you had invested in the other bond. Okay. Okay. So you will face more reinvestment risk. So this is in red, that means you should be concerned. Okay. So you face more in reinvestment risk when the coupon payment is more, right? So there are two bonds. So let's say there are two bonds. One bond pays coupon of $5 and one bond pays coupon of $10. Okay. So if the interest rate decreases in the market, you are getting only $5 from the one bond, but you are getting $10 from the second bond. So what is happening is, you have to invest $10 at a lower rate. So your reinvestment risk is more. Okay. Your reinvestment risk is more when the bonds are callable. That is, bonds can be called back by the bond issuer. Okay. When the bond is amortizing bond, that is along with coupon. So you have two bonds. One bond pays only coupon, but one bond pays coupon plus principal, right? So you have more money to invest at a lower rate. So when bond is amortizing bond, it pays this, and you are faced with more reinvestment risk. Okay. And when the prepayment options are present, prepayment options like callable is a kind of prepayment option, but let's say accelerated sinking fund provision is present. Okay. So that is increasing the risk. Or in case of amortizing bond, you say that, okay, when the interest rate falls, more and more amortization, more and more people will prepay. Okay. So when the prepayment option is present, you are thinking that you will get your money after 5 years. That is, you will get $100 as the principal after 5 years. But what is happening is, you have got now. Okay. So you are forced to invest this $100 now, and at a rate which is much lower than what you had expected. So this is the reinvestment risk. Okay. Please make a note of all these 4 points. Okay. Now we will see what is credit risk and what are the credit rating. Okay. We know that the yield of a risky bond should be more than the yield of a risk-free bond. Okay. So credit spread is the measure which is the difference between the yield of this risky and risk-free bond. Okay, so the credit spread is the difference between yield of risky and risk-free bond. Now the higher the credit spread, okay, the more risky the bond is. So let's say there is a risk-free bond trading at 5%. There are two bonds. One bond is trading at 7%. Okay, so the credit spread of this bond is 2%. Correct? Then there is another bond trading at 9%. The credit risk of this bond is, the credit spread of this bond is 4%. Okay. So what can be said about the price? Okay. So since the this yield is more, the price will be lesser. So the its price is lesser than this price. Okay. So as a result, I can say that the credit spread, larger credit spread will mean that there is a decrease in the price. Okay. So what will happen is there is a concept called credit spread risk. The credit spread risk is that what will happen when the credit spread will increase. When credit spread increases, the price falls. Okay. So credit spread risk is the risk that credit spread will increase. Okay. Now usually what happens is there are bonds, they have to get some ratings by the rating agencies. Okay. So you will find that a bond which is risk is very less, it is will be given a AAA rating. That is, there is very less chance of getting this bond default. Okay. Now you will find the S&P ratings like this: AAA, AA, triple B, like this. Okay. And in between this AA, they also specify like AA plus or AA minus. Okay. Within this they specify AA plus or AA minus. Okay. Up till triple B, the ratings given, they are called as investment grade. That is, these bonds can be invested, money can be invested in this bond. The probability of default is less. Okay. But then the ratings below triple B like BB, B, triple C, double C, C, these bonds are called as junk bonds. Okay. So these bonds are junk bonds. You should not invest in these bonds. Okay. Also there is a term called high yield bonds. That is, these bonds will be giving you high yield. So let's say if the triple A bond yield is, let's say, 5.5%, okay, the yield of triple B bond would be, let's say, around 7%. Okay, the yield of triple C bond would be around, let's say, 10%. So what is happening is, as the rating is going from triple A to triple B to triple C, the yield is increasing or the credit spread is increasing. Okay. So it might happen that due to deteriorating fundamentals of a company, the bond can be downgraded by the rating agency. So the bond can be downgraded by the rating agencies. Okay. So that risk is called as downgrading risk or downgrade risk. Because when a downgrading happens, the yield increases and the price decreases. Okay. So this downgrade risk decreases the price. Credit spread risk, it also decreases the price. Okay. If it, so downgrade will increase the credit spread. Okay. Similarly, interest rate risk. Interest rate risk, when interest rate increases, the price decreases. Okay. So that decreases the price. So that is a risk. Okay. So please be comfortable with what is credit risk. Credit risk is a type of a default risk. Okay. Credit rating are the rating given by the bond rating agencies, and they usually have these rating investment grade. Okay. These are the investment grade up to triple B. These are speculative, high yield or junk bonds, and then there is a grade called default grade, that is D, that is bond is in default. Okay. That is company has gone bankrupt, default, they have not paid the coupon payment. Okay. So that is a bond can be in default also. we have seen about liquidity risk. Okay, now please remember that when you have low liquidity, it means you have high liquidity risk. Okay, that means risk is more. Okay, we have seen that liquidity risk is the bid ask spread. Okay, you can say that if you want to sell the bond, you will not be able to get a good price, or if you want to sell a large quantity, the price can be depressed. Okay, so that is a liquidity risk which we see in practice. Okay, but you can say that I want to invest in a bond and I want to keep it for till maturity. Why I am, if whether I am exposed to liquidity risk? Okay, yes, you are exposed to liquidity risk, because as an institutional investor, okay, you have to value your portfolio. You have to give a performance measure to your clients. Okay, so what you have to do is you have to mark to market the price of the portfolio. That is, what is the value of the portfolio given that today is this market price is this. Okay, so you have to value your portfolio. Even though you are planning to hold the bond till maturity, you have to value the portfolio every day. So since due to low liquidity, the price can be very different than the fair value. It can be lesser. What would happen is the return that you are giving to your investor, it would be less than what actually it should be. Okay, so this is the impact of liquidity risk on the performance. Okay, and secondly, we saw that in repo, the bond, the institutions, they are giving the repo as collaterals. Okay, even in short sales, you can give the bonds as collaterals. Okay, usually what happens is when the bond given as collaterals have low liquidity, due to mark to market, their price will be lower. The borrower, the security lender, or the person who has given you the money will ask for more collateral, that is more bond. Okay, so that means you will have to post more collateral. So even though you are investing bond till maturity, you are still exposed to what is called as liquidity risk. Okay, now we'll see what are the other kind of the risk. Okay, so we saw that exchange rate risk. If you are investing in foreign bonds, okay, the amount that you are getting will be less than you actually want. So let's take an example. So let's take a scenario when $1 is worth 40, and a situation when $1 is worth 50. Okay, so suppose foreign investor had invested some money in India. Okay, so he invested $100. Okay, he bought a bond worth $100. So this $100 will imply that he has invested 5,000 rupee in India, and he got one bond. Okay, and the rate in India is currently 12%. So he will get 6,000 rupee after 1 year. Actually, it is a reverse case. So if an investor has invested $100 at let's say the price of 40, he would be investing 4,000 rupee in India. Okay, now let's say the interest rate that is being given, so let's say the interest rate that is being given is 12.5%. so after 1 year, he should get 5,000 rupees from India. Okay, so his return in dollar terms should have been 12.5%, or he should get back $100, $112.5. Ignore this. Okay, but when he goes and he exchange this 5,000, the exchange rate has become 50 now. Okay, so exchange rate has become 50, and after exchanging he is getting only $100. Okay, so what is happening is he invested $100, and even after 1 year he is getting back only $100. Okay, even though the interest rate was 12.5%. Why? Because of the exchange rate risk. The exchange rate has changed, or the foreign currency has appreciated. Here, like foreign currency has depreciated. Okay, sorry. So wherever you have invested, it is depreciated. So you are taking lesser money. So this is the exchange rate risk. Okay. Inflation risk, as we know that if the bond is giving you 5% return and inflation is around 10% now, okay, you are exposed to inflation, because at that time when you had invested, inflation was, let's say, 3% only. Now inflation has become 10%. You are getting a negative return. 5 minus 10 in terms of real return becomes negative 5%. Okay. Next is the volatility risk. Okay. Volatility risk is there in the bonds with embedded option. Okay. So we saw that diagram. Price of a callable bond was equal to price of a straight bond. So what, this is the straight bond and the callable bond price is this. So the difference was this call option value. So straight bond value is equal to callable plus call option value, or I can say that callable bond price is straight minus this, as this is the option value minus the call option value. Now you will see in derivatives that this option value, they increase due to increase in volatility. So they increase when the volatility increases. What happens is, due to increase in volatility, this will increase. As a result, the price of callable bond will reduce. Okay. So that will impact the price of callable bond, and that is a risk. Okay. Similarly, price of a putable bond. Okay, I will draw this time putable bond. Okay, so this is an option. Okay. So this is an option free bond. Okay, now you can have a putable bond which will have, like, you can put at a lower, at a price, right? So the difference between this, so this is a putable bond, blue one. Okay, this is a straight bond, and you add on that a put option value. Okay, so you are getting a higher price than what is the actual market price, so it will not fall below this. So due to volatility, again this value will increase. As a result, due to volatility, price of a putable bond will increase. So if you have invested in a putable bond, increase in volatility will make you happy, because the price of your bond will be more. Okay. Now we come to the last risk, that is the event risk. Okay, we say we have seen that some of the risks which are like outside the purview of or the control of the management can impact the bond prices. That is like event risk is like disaster, right? So a disaster can happen and it may ruin an entire company. So what will happen is the bond prices will fall because the assets are not there. Okay. Similarly, companies can go in for corporate restructuring. Okay. Restructuring of the firm, that means either selling of some unit or buying some other company. It impacts the cash flow. It impacts the debt ratio. Okay. So when a company has bought another firm, okay, using leverage buyout, that is by issuing more debt. Okay. Now since there are more debt, the company's risk has increased. So what will happen is the bond price should fall, because nobody wants to invest in a risky company. Okay, so they want more return. So a company can be company's bond can be downgraded by the rating agencies. Okay. Similarly, if there was a business which were doing really well, was generating lots of cash for the company, but the company has decided to spin off. Spin off means separate that division from the company and treat that as a separate company. So what will happen is the bond holders who were thinking that they will get cash from that business are not able to get that. So as a result, what will happen is it will impact the debt prices. Okay. Some things like outside the hand of the management are regulation. Okay, some regulations can impact the bond prices, right? Like one regulation can be that if you see the case of British Petroleum now, they have spilled the oil in Gulf of Mexico. Now what is happening is the government, US government is asking them to pay around $20 billion. So what is happening is this will result in the cash flow of the firm, cash outflow. They are selling some asset, etc. So people who have invested in their bond should be worried, because it might happen that the company may not have much cash for payment to the bondholders. Okay? So this can impact the bond prices. Okay? Also, uh, there can be some regulation that all the pension funds should invest in only triple A rated security. They cannot invest in double A rated security. In that case, what will happen is, if they were holding double A rated security, they will sell. And when most of the firms are selling this security, the price will decrease, and hence there will they will not be getting the fair value of those assets. Okay, so this is also another risk. Okay, so we have covered reading 61 of the session 15. This was a session which was interested in finding out what are the risks which a bond investor is exposed to. This was a very important reading. Please be thorough with the impact on the of the coupon, maturity, etc. on the bond duration, as well as on the reinvestment risk. Okay. Thanks a lot.